Hi everyone, welcome to what would normally be share and review. This week though, I've had a special request to look at the correlation between the New Zealand dollar and the US dollar, and obviously the impact that it does have on the New Zealand market. Now, bearing in mind, I am recording this on Tuesday, so we are a couple of days late, so the currency, could have well and truly moved in a different direction to what I'm going to show today. And the reason I stress that is because currency does move a lot quicker than shares. Okay, so that's just giving you a heads up there. Like normal, this is for educational purposes only. It is certainly not intended to be personal financial advice. And remember, if you're getting some value out of this, just drop me a comment, give me a thumbs up. Let me know what you'd like me to research for you as well, and just cast my views and that over it. That's all it is my views. So yeah, I'd love to hear from you. So let's take a look. Right, so I have got up here on the screen the New Zealand dollar versus the Australian dollar, and I've got it on a weekly chart, and I've also got it over a 5-year period. The reason being for that is I'm just trying to get a bigger picture, if you like, as to what is actually happening with the New Zealand dollar versus the US. Now, to begin with, obviously, the US dollar is the strongest currency in the world. And you might have heard some noise that Donald Trump, if he gets into power, he is going to look at devaluing their dollar. How he's going to do that, that's a topic for another day. But basically, he wants to drop their dollar to obviously make things a lot more affordable and that sort of thing for the States. However, for us and for most other currencies, especially if you're pegged against the US, what drives our dollar is our exchange rate, not our exchange rate, our OCR, our official cash rate. So I did some research last week, and I think I said about it. And at the moment, both our official cash rates here in New Zealand and in the States are the same. And off the top of my head, it was about 5.25%. We've both got AA credit rates as a country. However, given the size of the states, they are seen as a lot less risk than a small country like us here in New Zealand. Now, I'm taking out all other beliefs and that sort of thing, obviously, and debt ratios and the likes. So what happens, and what we saw this last week, initially, because our official cash rate dropped, was cut by 25 basis points, you immediately saw our cross rate fall against the US. Now that's normal, because at the end of the day, if you think about it, if you apply it to your own investing, why would you want to go into something that's seen as a little bit speculative versus something that's seen as secure for the same rate of return? So New Zealand being the speculative market versus the US being a lot more secure. Following that, what then happened is the Reserve Bank in America was then, the Federal Reserve they call it, was then starting to talk the following day and putting out signals that their cash rate was going to be reduced as well, be it 25 to even 50 basis points or half. That then drove our market. Okay, and you can sort of see that we had this very, very large candle here. Okay, so that was a very, very big spike up. And if I just change that back to the daily, you can see that here. Okay, it was a very, very big spike up. So even though we've had some quite strong performance, that really, really drove it last week. Now, obviously, that hasn't come through yet. And in fact, the US are talking that it might be later this year. It might even be next month before they start making any cuts. And the cut on the US dollar, or the US Federal Reserve rate, will depend on obviously what happens to our currency. Currency is also driven by supply and demand, and so at the moment there has been a bit of supply demand, obviously, for the New Zealand dollar. So that is what you're seeing here as well. But on the whole, our cross rates, if you like, tend to be driven on what's happening in the States. So just putting, and I've already got them on the screen here, I have put on the 15 period moving average, and this is a daily one because I'm on the daily chart, and also the 30. So a good positive sign here. We've seen the 15 period cross through the 30, which is great, which is what we want to see. Also down the bottom here, I have got the MACD on, and these blue candles are bars, if you like, are showing the volume, and then the shaded area is just sort of actually showing what is happening. So again, they're in convergence with each other. They're not diverging, because obviously if you were seeing the MACD coming down and our currency going up, then you've got divergence happening, which could be a little bit of an anomaly. And you can see that through this period here, through February, the MACD was showing strength, whereas actually on the chart we were showing a bit of a fall. Now, currency is a very, very sort of fickle instrument, and you can take it right down to minute charts if you want. I don't tend to. I'll just pop it on the hourly, and you can see here that the currency is very, very fickle, very volatile. And it'd be great if you'd ridden it through this period here. So back on the 16th of August was when the 15 period chart, if you like, crossed above the, or moving average crossed above the 30, and then we had a very strong run. Okay, that would have been great. Then it crossed down. Can't see that date. So yeah, crossed down. Then we've obviously crossed back up again. We could be crossing it. Who knows? Who knows? It's very, very fickle. One thing about currency, I believe, is you've really got to watch it. Okay, because it can run away, obviously for you, which is really good, or it can run against you as well. So just moving through. This is, like I say, it's a 1 hourly chart, so it can get quite noisy. So basically, how does that then work against the our share market, which was what the question was as well, daily. Now, what more than like is with the share markets, if you like, again, the US share market, even though it's not trading as high as our share market, is again still seen as the strongest share market in the world. And depending on what happens over there, and when I say that, so quite often, for example, if you see a sector such as banks or the financial sector undergo a bit of downward pressure, you will quite often see that follow through into our market the following day. So our market isn't exactly hinged on the US market, but there is definitely correlations there. And like I just said, if there's uncertainty within one sector, highly likely it will transfer over to our sector as well. And if you've been looking, this is one thing I've certainly taken notice of, basically since COVID, we, as a country, we do tend to be a little bit of a follower, as a way to say it. So if you took note during COVID, you would have seen that other countries went into lockdown, and eventually we went into lockdown. All of these sorts of things, we've obviously all now come out and we're all trading normally, but you saw the rest of the world go into a recession. You saw the rest of the world have higher interest rates, housing pressure, all these sorts of things, and we too have followed suit. So we do tend to be a little bit of a laggard what does happen globally. Now, it may only be as quick as a day that you see the US share market fall, and then you'll see ours fall as well. So we do tend to follow it, but we don't tend to exactly be correlated. And is there a relationship between the cross rates, the New Zealand cross rate versus the US versus our share market? Not necessarily. Okay, it does hinge on the official cash rates in the two countries, and you don't tend to necessarily see our share market fall just because the OCR has come down in New Zealand, or because the OCR has come down in America, or something like that. It does tend to work a little bit independent in that regard. What you do see, however, though, is if you do tend to get a weak cash market, so if our cash market starts to fall even more, which is what's being predicted, is you could likely see our share market continue to perform. And the reason for that, and it's definitely not set in stone, but so often if you have a weak cash market, you will quite often have a strong share market. And the reason being is that investors are looking to get a return on their money. And if they're not getting a return by having it in the cash market, cash in the bank, government bonds, that sort of thing, then you will quite often see people tend to go into the share market. There is an exception to that, and that was back in 2008. I was certainly giving financial advice back then, and we had the anomaly that we did have a strong cash market, and we also had a strong share market. Our share market has it's tripled since where it was trading back in 2008, but that was certainly an anomaly. Normally they will really work inverse to each other. So I hope that's helped. There's sort of a lot of moving parts in that, and I don't want to get too technical. I want it to be obviously relatable to everyone. So I really hope that's helped. Let me know in the feedback, and if, like I say, if there's anything you'd like me to discuss or bring up on the charts, happy to do so. Flick me a message. So until next week, take care.